This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
Fork in the road, the Dow and S&P hit levels never seen before, but they couldn't hold on. Now investors wonder if this year's big run-up might soon hit a roadblock.
Tougher rules, first the banks, then the insurance companies. Now, an arm of the Treasury is looking into tighter regulation of mutual funds, and it could impact many of the companies you likely invest with.
And mission critical. America's cities fund a big chunk of our economy, but many find themselves in a financial bind. Tonight we begin our 5-part series in Oakland, California, to see how that city is trying to fix itself. We have all that and more tonight on Nightly Business Report for this Monday, November 18th.
Good evening, everybody, and welcome. It wasn't easy and it wasn't smooth, but the Dow closed at another all-time high today. It's 39th of the year. Well, perhaps equally notable, the Dow crossed the 16,000 mark for the first time ever, and the S&P scored its own first, piercing 1,800. Neither index held those levels long, though. Stocks got a lift following encouraging comments earlier today by William Dudley. He's the president of the New York Federal Reserve Bank. Dudley says economic growth will strengthen next year and build even more in 2015. The jobs picture should improve, he says, and so should consumer spending. But late in the trading day, a wet blanket got tossed, and it came from none other than activist investor Carl Icahn. He told a Reuters summit that he's, quote, very cautious on equities right now, calling some companies' earnings a mirage, and says the market could easily have what he calls a big drop. Well, it wasn't big, but the market did drop after that. Here's a look at the final numbers for the day. The Dow, which surged as much as 67 points higher initially, finally closed up 14, good for that fresh record. The Nasdaq fell 37 points, dragged down by slumping shares of Apple. The S&P was off 6. So why are some market players like Icahn growing very cautious while others say, party on? Seema Modi takes a look.
The first trigger? Home sales began a round of fresh economic data on Wednesday, when we'll get the October number. If it's weaker than expected, the staying power of the housing recovery will be questioned. Also this week, inflation readings. On Wednesday, it's the Consumer Price Index, and on Thursday, producer prices, both expected to remain low. If not, and inflation is higher than expected, concerns will grow that the Fed will be more open to scaling back or tapering its monetary support. Another potential catalyst for a sell-off, earnings. This week we hear from the top retailers, Home Depot, JCPenney, Target, and Gap. Commentary from management could provide a window into holiday season expectations, a time when retailers in general do about 20% of their business for the year. There are also a lot of long-term headwinds, including Europe. It's still dealing with deflation and tepid growth, impacting the bottom lines of multinationals in all sectors. And then there are valuations. Remember those? As the market rips through new highs, stocks get more expensive. The momentum names powering the rally, like Netflix, Best Buy, and Tesla, all up better than 200% for the year, can only run so far. That has some market watchers worried, and some not.
We still think the market is attractively valued at these levels. So new highs are fine as long as earnings are continuing to keep up.
However, according to HSBC, valuations in most markets are slightly above their 10-year averages, prompting some analysts to disagree with the notion that the market will continue to move higher. For Nightly Business Report, I'm Seema Modi.
It was a good day at Boeing. The biggest gainer in the Dow today, with shares climbing 1 2/3%. The aerospace giant secured orders for a $100 billion order. That's of aircraft at the Dubai Air Show. Most of those orders were for the upcoming 777X jet, and they came from Mideast carriers. But only after Boeing inked deals to buy billions in parts and materials from companies based in Abu Dhabi. Boeing's top rival, the European plane maker Airbus, locked up $40 billion in new orders.
Meanwhile, Boeing continues to battle with union workers who build its planes. It's now negotiating with states outside of its home base of Seattle to build the company's new 777X jetliner. The move comes after union machinists in Washington state voted against a new contract with Boeing that would have meant reduced benefits and higher medical costs for union members. As for Boeing, it says it has no plans to reopen talks with the union.
J.P. Morgan Chase looks to be settling another case involving bad loans. The nation's biggest bank has agreed to accept responsibility for bad mortgage-backed securities sold by Washington Mutual, which J.P. Morgan acquired back in 2008. Terms of this newest deal clear the way for a possible $13 billion settlement with the federal government for all civil investigations over WAMU's failed investments. Now, the agreement with the Justice Department is now expected sometime later this week.
Home builder confidence is holding steady this month following 2 straight months of declines over concerns about the government shutdown. The National Association of Home Builders says most of its members are still optimistic that the housing recovery will continue, but some are worried that lawmakers will again fail to reach a federal budget and could shut down the government for a second time early next year.
Meantime, new data from the Treasury shows that foreign investors pulled out of short-term U.S. Treasuries in September during the last federal budget battle. Foreigners dumped nearly $107 billion worth of short-term Treasury bills in September, and the numbers for August were revised higher, showing an outflow of nearly $14 billion.
Investors were buying up stocks in China's markets today. The Shanghai Composite and Hong Kong's Hang Seng both rose almost 3%, following the announcement by Chinese leaders of massive social and economic reforms, including opening up its markets to more investors, encouraging competition among private companies, and allowing more foreign investment into the country. Now, another reform, the easing up on China's one-child-per-couple policy, which officials now say has caused an accelerated aging of China's population. And as Eunice Yoon shows us, that's created an unexpected boom in investing in the older generation.
At a nursing home in Beijing, Zhang Zizhong leads a sing-along with his fellow residents. The 82-year-old is one of a number of senior citizens benefiting from a budding industry in China, elderly care. Nursing home life is good, he says. I feel really safe. Due in part to the decades-old one-child policy, China is aging faster than other developing nations. The traditions of children supporting their parents is breaking down. Pension and healthcare systems here are ill-equipped, raising questions about how China will be able to take care of a rapidly rising number of old people.
In the next 20 years, less than 20 years, the number of elderly aged 60 and over would increase to over 400 million. That's larger than the total population of the United States.
Businesses like Right at Home hope to provide some answers. The company opened offices here 2 years ago to offer home visits.
There's no home care service, so we think the market is huge.
Local entrepreneurs are also joining in. Businesswoman Wang Yun converted a 3-star hotel, providing room, board, and activities for roughly $800 a month.
People here can visit the doctor 24/7. There's a pharmacy and a massage area, and these are just some of the services that this nursing home hopes will make it more distinctive in an increasingly competitive industry.
Still, Wang says retirement homes are not as culturally accepted as in the U.S. Sometimes children don't want their parents to go into nursing homes, she says. Sometimes the elderly are reluctant. Even so, most businesses expect their investments to fully mature, along with China's graying population. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Still ahead, Bitcoin. You probably heard the term, but how does this virtual currency really work? And why is Congress holding its first ever hearing on the matter? You may have heard about Bitcoin. That's a virtual currency that's been around for about 4 years, but is just now starting to gain more interest from retailers and from investors. And because of that, Congress wants to find out more about the digital payment system, whether it's secure and if it's good or bad for consumers. Mary Thompson was at a House hearing today in Washington, and she joins us now. Mary, let's start with some of the basics. What is Bitcoin and how does it work?
Well, Tyler, just as you said, Bitcoin is a virtual currency. So if you're going to buy one, you pay cash for Bitcoin. You keep it in an online wallet, and then you can use the Bitcoins that you have to pay for services or goods at retailers that accept Bitcoins. Now, a couple of things are different about a Bitcoin than, let's say, US dollars. First of all, it's not backed by a single government or a commodity like gold. It was also created by an anonymous Japanese programmer who limited the number of Bitcoins that actually can be produced to about 21 million. Currently, there are 12 million in circulation, and they are produced by computers solving complex mathematical problems. Once those problems are solved, they get a couple of more Bitcoins that are put into circulation. And the value of the Bitcoin, well, that's determined on a number of internet exchanges around the globe where investors and retailers trade these digital currencies.
It sounds a little complicated for the individual guy. I don't know how the Congress, felt about all of this information. Why are lawmakers looking into the Bitcoin?
Well, there are two reasons. First of all, there's a lot of hope in these, or promise in these digital currencies, primarily for two reasons. One, the speed at which you can transact, meaning I can send money from my online wallet to you in a matter of seconds, possibly without any of the transaction fees that you might find with a credit card or even transferring money from one bank account to another. Also, there's expectations that you could bring financial inclusion to millions of people who don't have access to a bank or cash, but may have access to a phone where they could store their digital wallet. But of course, there are concerns as well, in large part because criminals see digital currencies as their favorite form of money. And as we heard in testimony today from Edward Lowry of the Department of Homeland Security, that's made their, or from Secret Service actually, that's made law tougher trying to track fraud. Listen in.
One of the largest changes is the reach of the criminal. It used to be that we had to worry about, back in the days of early access device fraud, we had to worry about someone dumpster diving or trying to get an actual, image of your credit card. Today, anyone in the world can reach anyone else in the world, and that's changed how we have to enforce our laws.
Point of discussion again in today's hearing.
Mary, who's using this? Who's investing in it? And what is my risk? In other words, could my Bitcoins lose value?
They certainly could lose value. What we've seen recently is a huge jump in the value of Bitcoins. It first came to, I think, the general public's attention during the Eurozone crisis. A number of investors or consumers in Cyprus looking for a place to store their money. Well, basically, they said they put their money in Bitcoin. The price of Bitcoins rocketed. And since then, we've seen investors from China taking a renewed interest in this, retailers from China starting to accept it as a form of payment, and then investors in the United States, famously the Winklevoss twins, who were early investors in Facebook. They have been proponents of Bitcoin, but more recently, Second Markets has opened a Bitcoin investment trust. So we're seeing global interest in the digital currency. But again, if you look at how far it's climbed, it could easily fall just as fast as people start to lose interest in it.
All right, Mary, thank you very much. Mary Thompson reporting from the Hill for us tonight. And for more on Bitcoin and today's hearings, head to our website, nbr.com.
A boost in chicken and beef sales helped Tyson Foods grow profit, and that's where we begin tonight's Market Focus. Tyson's net income surged more than 40% in the fourth quarter. Earnings and revenue beat estimates, and the company raised its dividend 50%. That sent shares up more than 2% to $29.42. Salesforce.com saw quarterly revenue increase, beating analyst estimates slightly. The cloud computing company posted earnings after the bell that were in line with forecasts, and it also issued a mixed outlook. The stock closed the regular session down 3%, closing at $55.51, and then rose just a bit in after-hours trading. Also out with earnings after the bell, Urban Outfitters. It reported a record third quarter, beating both earnings and revenue estimates. Quarterly profit increased 18%, and it was driven by strong growth thanks to its Anthropologie and Free People retail chains. The stock rose in after hours. Shares finished the regular session down 1% to $39.64.
Super Value was hit with a downgrade today from Goldman Sachs, and that sent shares of the grocery chain way down. Goldman lowered its rating to a sell because of headwinds such as recent food stamp cuts and increased competition in the grocery business. The stock off almost 9% to $6.28. Bank of America Merrill Lynch thinks the market is a little too excited about Microsoft's CEO transition, and analysts downgraded the stock from neutral to underperform, saying that there could be a 10% drop off in Microsoft shares if Ford's Alan Mulally isn't chosen as Microsoft's next CEO. An announcement is expected next month. That sent shares down of Microsoft 1.5% to $37.20. The Chinese solar equipment maker Jinko Solar posted a second straight quarterly profit, sending shares to a 3-year high. Increased electricity revenue from solar projects helped the company post strong results. Jinko Solar also upped its shipment forecast. The bright outlook sent the stock up nearly 13% to $33.30. Sony sold 1 million PlayStation 4 consoles in its debut on Friday. That's the fastest start for a PlayStation system ever. Sales are being watched closely since Sony is depending on the PS4 to revive its consumer electronics business. Some customers reported glitches with the device, but that didn't seem to spook investors. Shares up 1% today to $18.72.
From Washington, word that the Federal Reserve might decide to push back the date that banks will have to comply with the so-called Volcker Rule. It's an important part of the law that's overhauling the way Wall Street banks are regulated. The Volcker Rule is designed in part to prevent future taxpayer-funded bailouts by prohibiting banks from investing their own money for profit.
There may be some new rules coming to the mutual fund industry. The government is now considering tougher regulations to protect investors against another financial crisis. Our next guest says it could be a big mistake. He's Brian Reed, chief economist at the investment company Institute, the mutual fund industry's chief trade group. We have a statement from the Treasury Council that put out this study regarding those rules, and I want to read it now, Brian. The council is in the early stages of analyzing the asset management industry and its various activities. As that analysis moves forward, the council will continue to be informed by the work of the OFR and welcomes continued engagement with asset managers and other stakeholders from across the spectrum. That from the Treasury. But Brian, your group and many in the asset management business, from BlackRock to Fidelity to PIMCO, say that the study on which these potential new rules is based is brutally flawed. Why is it so bad?
Well, I think the biggest problem here is that it fundamentally sort of ignores sort of how the capital markets and mutual funds and ETFs operate in those markets. There's a big chasm between the capital markets and mutual funds and banks on the other side. And this study just completely tries to paper over that chasm and not really focus in on the unique features of capital markets. And could really, at the end of the day, just turn the capital markets and mutual funds on their heads.
Well, you know, Brian, investors have been happy that in the aftermath of the financial crisis that there were new safeguards put in for banking, new regulations, the same for insurance companies. And here you've got the mutual fund industry. It's a $53 trillion industry with a lot of players. Why not this industry, too?
Well, I think, you know, the statistic that you cite there is one that comes from the report, and I think that's a key example of how the report sort of fundamentally misunderstands the asset management industry. And I'll give you another example, and that is we went through, as you allude to, the worst financial crisis in 2007, 8, and 9, probably the worst since the Great Depression. And in that report, there's nary a discussion of how funds and fund investors operated in those markets and how they behaved. You know, we saw outflows to be very minimal. They accounted for, even in October of 2008, the worst month, outflows from stock funds about equaling 0.4% of the overall market capitalization. But there's no discussion of that in the report. And so they make these very broad, sweeping generalizations and don't use the opportunity to look at a natural experiment that occurred and say, okay, what can we learn? I think if they had done that, there wouldn't be this sort of consternation that you're observing.
Yeah, but I guess my counter to that, Brian, and I mean it with all respect, is that there aren't runs on funds until there are, and so the mere fact that investors didn't panic in 2008 doesn't mean that at some point they mightn't panic. That's number one. Number two, back to Susie's point, insurers, even GE Capital, companies like Prudential have been designated as systemically important. You're not saying that funds aren't important or big, are you? You're saying that there is something in the structure of the way funds operate that inoculates them from the same kinds of risks that these other big financial players have?
What is key here is that very point, Tyler. I mean, when I invest in a mutual fund, be it a stock fund or a bond fund, I know that I could potentially experience losses just as if when I invest in bonds or stocks themselves, but I also have the upside potential. And what an asset manager does is manages that portfolio, but that asset manager doesn't say, I'm going to protect you, nor should the government say, I'm going to protect you. I mean, if the government begins to go down this slippery slope of trying to intercede and interject itself in the capital markets, it could fundamentally destroy probably the world's largest and most vibrant capital market.
Brian, let me ask it this way. So let's say I'm an investor in Fidelity, and a bunch of us investors decide, I want to sell off. I'm worried about some market event or something like that. Are you saying that other investors in that fund are protected, that there's no ripple effect, there's no impact?
What I'm saying is that those funds are marked to market every day. Their prices are set with all the other assets in the market. So that investor is not harmed because they're getting a new price every day, a full mark to market price. Unlike when I invest in a bank, that is staying at $1. And so I think the key here is that when I invest in a fund or I invest in a stock or a bond, I know that I could potentially lose money when the market goes down. But the harm to me is from the market going down. And that's what I expect as an investor. The markets are going to go up and down.
Brian, thank you very much. And we should point out that we did invite representatives from the Treasury and the Financial Stability Oversight Council to join us this evening. They sent us a statement, and maybe they will join us at another time. Brian Reed, Chief Economist at the Investment Company Institute. Thank you.
Thank you.
And coming up on Nightly Business Report, 5 cities, 5 issues in 5 days. Tonight, we take you to Oakland, California to see what that city's doing to fix its badly broken finances.
An update now on the botched rollout of the Affordable Care Act's healthcare.gov website. Henry Chow, a top information officer at the agency overseeing efforts to fix the online marketplace, wrote to Congress today that the website is improving and says his department, the Centers for Medicare and Medicaid Services, even hopes to expand the site's income subsidy estimation tool. Chow is slated to update the House Energy and Commerce Subcommittee on the healthcare marketplace tomorrow.
Meanwhile, United Healthcare has dropped thousands of doctors from its networks, leaving many elderly patients in the lurch and wondering if they can still see their longtime physicians. United Health said that the cutbacks are a result of government underfunding of Medicare Advantage plans for the elderly, along with more money being spent on covering premiums on medical claims from last quarter.
And finally tonight, NBR has the first of a week-long series taking an in-depth look at the tough economic issues facing some of America's biggest cities, many of which are in critical condition. Scott Cohn starts us off tonight from Oakland, California.
If you want the Holy Ghost, yes, tell her what you want.
Curtis Robinson isn't your average pastor. Before he took the pulpit at Oakland's Faith Baptist Church, he spent more than 20 years as a stockbroker. His financial background still figures in his work.
You got to have a peaceful neighborhood in order to have economic development.
Peace comes at a premium in Oakland, with 127 murders last year and the highest armed robbery rate in the country.
First of all, we have to have sufficient resources in our police department.
Mayor Jean Quan says the city is hiring officers again, but the force is still down by roughly a quarter in the last 6 years, thanks to budget cuts. It doesn't help that about $4 million a year, around 2% of the general fund budget, is going not to Oakland, but to Goldman Sachs.
We have tried to negotiate with Goldman Sachs, and I haven't totally given up.
The payments are the result of a 15-year-old swap contract sold to the city to guard against rising interest rates. Trouble is, rates went down, not up, and the city wants out. But under the contract, that would cost around $15 million, money Oakland doesn't have. Curtis Robinson thinks Wall Street took Oakland for a ride.
Oakland was just outgunned.
Goldman Sachs declined to comment, but asked about the deal at last year's annual shareholders meeting, CEO Lloyd Blankfein said it's not fair to ask Goldman to simply tear up a legitimate contract. That, he said, is not how the financial system works. Oakland is not alone here, and neither is Goldman Sachs. Wall Street sold hundreds of these swaps contracts to cities in the 1990s, making millions of dollars. Organized labor says the deals are costing the cities about $1 billion a year. That's particularly frustrating as unions look at cuts in their benefits, and that's the issue we'll take up tomorrow. We'll travel to Chicago, where a municipal pension crisis is making Detroit's problems look like child's play. Scott Cohn, Nightly Business Report, Oakland.
And that's Nightly Business Report for tonight. I'm Susie Garrow. Thanks for watching.
And thanks from me as well. I'm Tyler Matheson. Have a great evening, everybody, and we'll hope to see you back here tomorrow night.
Nightly Business Report has been brought to you by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
I'm Susie Garrow with a Nightly Business Report news brief. The Dow closed at another all-time high today, crossing the 16,000 mark for the first time ever, just as the S&P 500 pierced 1,800. Stocks got a lift on encouraging comments from a Federal Reserve official about higher economic growth next year. But then stocks cooled after activist investor Carl Icahn said he's, quote, very cautious on equities right now and says the market could have what he called a big drop. At the end of the day, the Dow closed up 14 points, the Nasdaq fell 37, dragged down by slumping shares of Apple. The S&P was off 6 points. Boeing secured $100 billion worth of new aircraft orders at the Dubai Air Show. And home builder confidence leveled off this month following 2 straight monthly declines. Be sure to tune into Nightly Business Report right here on your public television station.